What's up, everybody? Welcome back to The Contrarian. Today I'll be taking a look into the gold market and the recent price action that gold has had, basically on the result of the dollar weakening, as well as potentially gold beginning to signal or beginning to price in an upcoming Fed pivot, similar to how the gold market has in the past. So today I'll be taking a look down memory lane in the past when gold has accurately predicted the Fed pivoting in the past in terms of going back to a more easing monetary stance. But I'll be taking a look at that as well as current economic weakness and the price action gold has had in the recent months, the recent rally that gold has had, as well as the recent correction that the dollar index has had. So I'll just dive into it right now. Basically, gold is probably factoring a lot of these economic conditions into account when it's taking the recent rally that it's currently had. Now, gold in the last 2.5 years has been a very boring asset to hold. It's been in a consolidation pattern, what a lot of chartists, including myself, would consider to be a bull flag. It ran, obviously, through 2019, through 2020, made a new all-time high of around 2,080. And since then, it's basically been in a range between 1,600 and 2,080. It reached that high again about this same time last year when the whole geopolitical tension issue began to be priced into gold as well. So it's basically bounced around within this range during the last 2.5 years. And because of this, the gold market has been in a place of just extreme pessimism, you could say. There's not very much optimism right now in the gold market, or at least there hasn't been for the last 2.5 years. The gold market's a very emotionally driven market, is something that I've gotten to learn in the last 2.5 years is people's emotions is swayed very easily, even to something as a simple 10% price move one direction or the other changes people's emotions very dramatically. So it does take a lot of, you could say, guts to be in this market, or at least just a longer term horizon and reasons beyond just what is, mainly commonly perceivable out there to be in the gold market, precious metals market as a whole, I should say. But gold is likely beginning to price in a few things. It's likely beginning to price in the extreme treasury yield spread that's currently going on, and this is referring to how inverted the bond market is right now. You have to go back to the early 1980s to get anywhere close to how inverted the bond market is. The inversion between the 10 and 2 year is negative, and it's as negative as it has been in a long time. So gold's likely beginning to price this in as a very bad sign for, likely an upcoming very severe economic recession around the world, not just for the U.S., but around the world. So the gold market's likely beginning to price that in. Gold is also likely beginning to price in an upcoming Fed pivot, and this is where I've gotten some pushback recently, people saying, no, the Fed is not going to pivot. They're going to continue to, self-destruct. That's their agenda. So what the issue I see with this is nowhere in past economic history has this ever occurred, that the Federal Reserve or the central bank of whatever kind that is in place at that time, it's never happened where they've reversed course, they've suddenly gotten religious and convicted of their past mistakes, and then they decide to change course and all that. That's never happened before. They've always gone the route of continuing to debase their currency until it eventually becomes worthless. Now, the specific ways in which they debase their currencies is a bit different between central bank to central bank, but nevertheless, it goes down that similar path. And so I just very much so hesitate to think that the Fed is going to be the first central bank to ever do that, or even any central bank around the world that they ever do that. A good example of this right now is we're beginning to see the Bank of Japan having to really backpedal on their, the tightening that they tried to do there. It's nowhere near the tightening that the Federal Reserve in the U.S. was able to do, because Japan is a whole different scenario. They're way more in debt, somewhere 250% debt to GDP. So Japan is in a far worse situation. They had to backpedal way sooner than the Fed. But I would expect the Fed to also have to do something similar to what the Bank of Japan is doing right now. And it's likely that the gold market is beginning to price this in. And the gold market has been very accurate in terms of predicting past pivots that the Fed has done. So let's take a look at that. So you have the major run that gold had basically beginning of 2019 to mid 2020. Gold ran about 80%, you could say. That was a major bull run that gold had, and it was actually in anticipation of the Fed going back to an easing policy. That obviously the market threw a sort of taper tantrum, is what it was called, at the end of 2018. Jerome Powell had to pivot off of that and say, no, we're not going to go back to quantitative easing. But of course, the gold market saw right through that, and that is what the Fed continued to do. And so obviously COVID played into that a lot as well. You see a brief correction that gold had during the sell-off that everything received during that 6 weeks there in early 2020. And then gold continued to rally onward as the Fed went into ever more quantitative easing and money printing after the whole COVID lockdowns and everything. So since mid-2020, gold has been in a consolidation pattern, a bull flag consolidation pattern, technically speaking. It touched the top most bound again of around 2080, and then just a few months ago it touched the bottommost bound at around 1600. So for the last 2.5 years, gold has been in this consolidation flag pattern. It would be my expectation that once gold does breach 2100, it's going to continue to rally, similar to how it did prior to the Fed pivoting in 2019. My expectation would be that gold would run in a similar, maybe plus 80% move from there. Maybe not quite 80%, but a sizable percentage from there. It would very much so change the sentiment in the market right now. Already, it's beginning to be a bit strange to see some people like David Brady, others like him who are gold bugs. They've been in the gold market a while, beginning to be skeptical of gold's move right now. And to me, this maybe indicates that it could be a shift in sentiment that they are maybe not as much so aware of. I'm not saying that David Brady isn't correct in saying that gold could correct from here. I do think it could, continue to consolidate and correct. But it would be my expectation that once gold does break definitively above 2100, all of a sudden you're going to get a very dramatic shift in sentiment from the, just disinterest that's been in the market for the last 2.5 years. All of a sudden, pension fund managers, hedge fund managers, everybody who's been just ignoring gold completely is going to take a second look. You're going to see people begin to buy into gold at a much more elevated rate than where they have in the past. That's just how sentiment works, and it's a very important driver to pay attention to because basically when nobody's interested in an asset class, you want to take a look into that asset class, see if there's something valuable there. When everybody's interested in it, when everybody in your family is suddenly talking about, oh, I need to buy physical gold, how much do you have, Logan? You should buy more physical gold. It's at that point that you actually want to take a look and see if you should maybe get out of that market because it's starting to become crowded. But I'm definitely confident in saying that gold is nowhere close to being a crowded market right now. And when it does begin to be a crowded market, it's going to go up very dramatically in just total market cap, whether you're looking at miners or physical metal or physical silver, etc., because it's such a small market. Once even a small percentage of people begin to get into gold, it's going to have a very, very sizable rally. So, even looking back in the very dramatic bull run that gold had in the early 1980s, the late 1970s, I should say, at the peak there was around 9% of U.S. investors who had a portion of their portfolio in gold or gold miners. So 9%, that's very little. Right now in the U.S., maybe it's around 1%. I need to verify that statistic, but it's a very small percentage of U.S. investors who have a sizable portion of their portfolio in gold. The peak in 1980 was around 9% of U.S. investors. I'll try to find this statistic for all of you, but that's basically saying that the gold bull market has just barely started, in my opinion. It might not have even started yet. The next leg up, I do think it is very close. We're probably beginning to see just the first signs of the coming Fed pivot, and when that does happen, gold will probably be well on its way in the next leg up in the precious metals bull market. So all of that being said, let me know what you guys think about all of this down in the comments section below. Do you think the Fed is close to pivoting as the gold market might be indicating? Do you think gold's only rallying because of the correction in the dollar index? Maybe it's a portion of the two. I'd love to hear all of your comments and thoughts down in the comment section below about the precious metals market, what you think could be happening in the precious metals market. So let me know what you all think down in the comments section below, and I hope to see you all again at some point.